Hello and welcome to Foundations in Accountancy, paper MA2, Managing Costs and Finances. This is chapter number 2, and within chapter number 2 we focus our attention on the cost accounting systems. Now this fits in very nicely with everything else that we're doing from a management accounting perspective, because what the cost accounting system does and what the cost accountant does is they will gather data. So they will gather data. This data will be from an internal source. So they gather internal data, and what they do is they will then gather the data, they will then store it. It can then be analysed by the management accountants. So the cost accounting system gathers and stores the data and then allows it to be analysed. This type of cost accounting system could potentially be a computerised system, or it could potentially be something very, very simple, such as bin cards being collected and timesheets being filled out by individuals, and then all filed together in one overall place and allowing it to be analysed by somebody else later on. Now, this type of cost accounting system, this costing system, only looks at internal data. It only looks at it from an historic perspective as well. So all of this stuff is old and it's out of date and it's always internal. When it then gets passed over to the management accountant for them to analyse and then turn into information that can be used for decision-making purposes, the management accountant will take into account the external environment as well, and then armed with his understanding of the internal historic performance and the external expected impact of the environment, he can then make a prediction of what he thinks should happen in the future. So what happens is the costing system is past data. So it's past data, it's old, it's out of date already. The management accountant will then take that, try to analyse it and try to work out what it's trying to say, and then try to give us an understanding of where we think we could be going with this sometime in the future. The cost accounting system, so the cost accounting system, which uses this old historic data, will usually have some sort of double entry system included as well. Now the double entry system that you've got here from a costing perspective will be a wonderful big T account, as you've seen before. On the debit side, you tend to find these things will be inputs into the process. The credit side will be outputs from the process. So if you think about the process, our actual production manufacturing process, if you think about that process as the T of the T account, inputs appear as debits, they then get processed by the T account, and they get spat out the other side as outputs from the production process. The management accounting system does not need to be part of the double entry system, because the management accounting system will try to predict what's going to happen in the future. Accounting systems, such as our double entry ledger accounting system, are not able to deal with predictions. So they're not able to be able to deal with what we think is going to happen in the future, which means that we couldn't really deal with that. Now the focus of this chapter is very much on cost accounting issues. So let's get right back into the cost accounting issues. Cost accounting is all about costs of production. It's not just about costs of production, it's also about levels of production as well. And what we do here is we will try to identify all of the costs associated with production. So we will try to identify all of the costs associated with production, such as raw material, labour, and then various other overheads as well. Those other overheads are potentially production costs, which will include direct and indirect costs, and then also non-production costs. So there'll be production costs and then also non-production costs. Now, how this cost accounting system fits into our overall financial accounting system and into our overall organisation is actually quite an interesting aspect. Because what happens is the cost accountant collects data. The cost accountant will collect that data and then passes it on to the managers. The managers will then take that data, add in their external environment, and they'll come up with some sort of predictions of what they think will happen. Those predictions will form information. That information is then given to managers. The managers then make a decision. The impact of the manager's decision is then measured by the financial accountant. So we've got the cost accountants looking at historic data. They're collecting that data together. They're then going to pass it over to the management accountant. They then process the data, turn it into information. That information gets handed over to the managers. Managers make the decisions. Once the managers have made those decisions, there will be an impact from those decisions. That now gets measured by the financial accountant. Now, what you can have is you can have a single accounting system, so a single accounting system where all of the financial accounting information and all of the cost accounting information, and I'll put in brackets management accounting information as well, will come from the same source. If you have a single system, so if you have a single system, that's known as an integrated system. If you have two separate systems, then these two separate systems will need to be reconciled on a regular basis. We call those interlocking systems. Now, from a cost accounting perspective, the idea of having a financial accounting system and a management accounting system stroke cost accounting system, which comes from the computerized accounting system that we have, will now hopefully mean that we can have better decision making. So we can have better decision making because managers will get better quality information. Better quality information will allow for better quality decisions. It doesn't always guarantee it, because you may find that the manager still makes the wrong decision anyway, even though he's got the perfect answer in front of him. He takes the wrong option. Also, it allows for the development of the business. So it allows for the development of the business. And as we try to implement new development initiatives, it allows for better control. One of the ways we can evaluate control is through the use of things such as variances. And we're going to look at variances a little bit later on within this syllabus. So it assists in development, so the idea of moving forward, allows us to exercise control, and control will result in a difference between expectations and our actual results. That will now result in what we call corrective action. So control is exercised through corrective action. So control is exercised through corrective action. And one of the ways we then implement the policies will be, it may be through variance analysis again, or it might potentially be through the financial accounts, which will actually tell us whether we've made lots of profits or not. So the implementation of these things have an impact, and the impact has to be evaluated. Now, the two different systems that we have from a bookkeeping perspective, we've got an interlocking system where we have two separate sets of ledgers. So we have two separate sets of ledgers. This is a complete bind, and in the real world, it's very unusual to find nowadays. With the development of computers over the last couple of 100 years, we now have the ability to have properly integrated systems. So interlocking accounts are a little bit unusual, but they do crop up in exam land quite a lot. So you still need to understand the definition of these things, I'm afraid, guys. The other side of this coin is to have an integrated set of accounts. So integrated accounts are where everything comes from a single source. So integrated accounts is where everything comes from a single source. This actually saves time and costs because you don't need to reconcile everything. It's just right. So you don't need to save time, or you can save time and you don't need to reconcile it. Therefore, it just makes life an awful lot easier. So these type of systems, this type of integrated system is usually much better. One of the things that we'll actually do within our cost data is we will identify cost units. Now, cost units are the things that we actually generate income from. So these cost units are products or services, so products or services which will incur an element of cost. When we incur that element of cost, we then use it further on to try and sell it at a profit. Examples can include things such as a car manufacturer will be cars. A hotelier will be occupation of rooms. And it won't necessarily be one room being occupied for the entire year. It might be numbers of rooms per night. So it could be occupancy on a daily basis. An auditor, which is a classic service provider, looks at things such as number of audits completed. So every single type of business which has any type of outputs can have cost units. These cost units are important to me because it allows me to understand what I need to try to control the costs of. I need to reduce potentially the cost of cost units, and I need to potentially increase their profits. So I need to sell them at a high price and produce them at a low price. If there's a huge quality issue, sometimes I will increase the cost to maintain quality. There's a huge quality drive within the auditing world at the moment, and what happens here is we make sure that the audits that we complete are of top quality because we need to make sure that they're going to be correct. And to do that, we have to spend more money. So the cost unit as an audit you may find it actually gets increasing costs rather than decreasing costs. Now, to ensure that all of this data that we collect can be attributed to the specific type of activity which has incurred the cost and allows me to see which type of cost unit has used up that type of activity, we have various different cost codes. And these cost codes can be very sophisticated methods of identifying what a cost is, how much the cost actually was, where it came from, who allowed it to be incurred, who actually used it, and what type of benefits we get from this. It can be amazingly detailed. This is a very, very sophisticated mechanism. So it's something that you need to be very, very careful with. There are various different methods of setting up cost codes. And some of the methods that you need to know about within this syllabus are as follows. Now, I'm not going to sit here and just reel these things off to you because we're going to go through them one at a time. You are guaranteed to get questions on this. Absolutely 100% guaranteed to get questions on this. So you need to make sure you are completely happy with the definition of every single one of these types of cost codes. Now, a cost code such as a generic or functional cost code is where the code is made up of several different component parts. And what will happen is the cost code itself is split down into separate sections so that, for instance, the first two numbers may potentially say this is the cost center that's incurred the cost. So you might be working for cost center 1-2, or you might be working for cost center 0-3. That now means those first two numbers tell me as the cost accountant who's actually incurred these costs. Then what we do is the next component part might say what type of item is being produced. So what type of cost unit am I interested in? It might be what type of cost is it? Is it raw materials? Is it direct labor? Is it something else? These codes can get very, very sophisticated and very detailed very quickly. That's the good thing about these. They can get very sophisticated and very detailed. Gives us a huge amount of information. The downside here is they can get very convoluted. They can get very detailed. So it's not a perfect, but it is quite a good code. Sequential coding, basically what happens is we start with number 1, and then whatever comes up next, we just give it the next number 2. The good thing about this is everything just gets a number, and if you're trying to allocate the next code to something, you know exactly what needs to be allocated. The downside here is it gives you no additional information. You need to go to an additional listing and an additional index to work out what those codes actually mean. So the code itself doesn't give you any additional information, which makes it quite poor. An additional example of coding is our hierarchical coding. And hierarchical coding looks at a structured system which is similar to a generic system, however, it builds upon itself. So instead of saying that Douglas is code 11 and Peel is code 12, what we say is sales are code 1. Douglas sales are 1.1. Peel sales are 1.2. So there is a huge amount of information still contained within that. However, these type of hierarchical codes can get quite detailed and quite convoluted very, very quickly. That said, that was the same issue we had with the generic and functional codes. So they're good because they give you a lot of information, but the downside here is they give you too much information sometimes, and you may lose it within all the detail. Block coding is where similar items are all coded together and given similar codes. So for instance, you may find that you have a set of accounts which are coming about from your accounting system, and within your accounting system you'll have a chart of accounts, which is a list of all the different ledgers you can post to. All the different ledgers which are similar in nature will have similar numbers. The example I tend to use is if you had a chart of accounts which was numbered, all of the 6,000 numbers might be different bank accounts. So 6,010 might be bank account number 1, 6,030 might be bank account number 5. All of the 6,000s are bank account numbers. That's good because it gives you a little bit of information, but not a huge amount. It's bad because it doesn't necessarily give you sufficient information. So again, it's good and bad. Every single code here is good and bad. There's an advantage and disadvantage to each of them, and you need to make sure you're aware of that. Faceted coding is quite a sophisticated code, and what happens here is the code can be broken down into separate fields or facets. Each field represents a specific piece of information. So a faceted coding system is where each part of the code is broken down into different parts. Each different part will be dealing with a specific area or a specific issue. Again, this can give you a huge amount of information, but there may be an overload there. Now, all of those codes we've been looking at so far, we've really been looking at number-based codes. What we then have is mnemonic coding. Now, as you come through more and more of your studies, you'll notice that we try to use mnemonics as a way of remembering things, such as when you look at internal control mechanisms for any type of organizations, we use OAP SPAM or SOAP spasm. So there's the SOAP maps rather. So there are different ways that you can learn things. And mnemonic is just using a load of letters together to give you a better understanding of something. So it just allows you to shorten it down. So mnemonic coding would include things such as LTL for long-term liabilities, NCA for non-current assets. Doesn't give you a huge amount of information because it doesn't tell you what type of long-term liability or what type of non-current asset, but it gives you a basic understanding of what's going on. Now, within the organization as a whole, the organization can be seen as a system which collects data, processes it into information, allows decisions to be made. Those decisions have an impact. That impact will be recorded, and then outputs will be churned out, which will be in the form of financial accounts. So our information system, so this is not the manufacturing system, our information system can be seen as a simple system where stuff is input, usually data. It then gets processed, which might be the management accountant or potentially the financial accountant. There'll be then some sort of backing storage, which allows stuff to be looked at in the future. And then there'll be an output. The output might be full-on financial statements. The output may potentially be information for decision making. And that's the type of thing we focus on within this syllabus. We're very, very interested in the idea of information for decision making. And as we go through the rest of this syllabus, you'll see we keep on focusing on that. We're not that interested in producing financial statements. Hopefully that's given you an idea of the data issues. It's given you an idea of how all the different data and information are linked together within an organizational structure. That does bring us very nicely to the end of chapter number 2. Please make sure you have a go at the online questions before you progress to chapter number 3. And remember, anything that you're not sure of, go back and listen to the recording again. Thank you very much for your time and attention. I'll see you all again very, very soon.